Hello, welcome to the second episode of the mini series where we're looking at the legal skills that law school never taught you. And today's episode is entitled The $40,000 Math Era and How to Read Form 433A like the IRS does. Welcome. I'm glad you decided to join us for our second episode of our mini series. I am Nafisa Manira, and let's get started. Let's jump right into it. First thing, let's just take the example of you have an attorney who submitted their client's offer in compromise with an offer to settle their client's tax debt for $5,000. The IRS takes a look at it and issues a counteroffer for $45,000. Same client, same debt, same facts. So what went wrong? What's this difference between the 5,000 and 45,000? Well, what went wrong is you as the attorney did not understand how the IRS calculates the reasonable collection potential of clients. Did not know how to read the Form 433A like the IRS does, and therefore committed this $40,000 mistake. So today, I'm breaking down for you how to read the Form 433A like the IRS does. And for those newbies who are joining us, Form 433A is a financial disclosure that you may have to submit on behalf of your client, depending on what tax debt solution you have chosen for your client. Now, the IRS uses a specific formula to determine whether your client can actually afford to pay the tax debt that he or she owes, right? And this particular formula is called the reasonable collection potential. Now, how is it calculated? Well, the RCP, reasonable collection potential, is calculated, it equals asset equity plus future income. So the IRS is looking at your assets, your equity in assets, and adding to that what your future cash flow looks like. And this formula is called the reasonable collection potential, the RCP. Sounds really simple, right? Well, we all know that it's not all that simple, right? And the reason why it's not that simple is because the IRS uses very specific rules for what qualifies as equity. What is equity? What counts as equity? Number two, what expenses are actually allowable? And number three, how do you actually calculate that future income? See, once you know these rules, then you're able to calculate your client's RCP more effectively and not get it rejected from the IRS based on your miscalculation. Okay? So I want to talk about the three mistakes that a lot of attorneys, CPAs, and EAs make when they're trying to calculate this RCP. The first mistake is number one, and this is a beginner's mistake, using actual expenses instead of the IRS's collection financial standards. So let's take an example. Your client pays rent of $3,200 a month, okay? $3,200 a month, that's what your client pays. That's what you put down on the Form 433A, okay? Now, according to where your client lives, the IRS has established a standard that says that rent can be no more than $2,200, right? It can't be any more than $2,200. So that's all the IRS is going to give you for that. So even though your client is paying $3,200, the IRS standard is $2,200. So you have $1,000 difference right there. And that $1,000 the IRS is reading as, oh, this $1,000 is available to pay us. That's how the IRS is looking at it. And so they're going to multiply that times 12. They're looking at it, oh, that's an additional $12,000 that your client has to pay us. If it's over 24 months, that's an additional $24,000 that your client has to pay us. If we're talking about 60 months, 5 years, right? What are we talking about here? 12 times 5. We're talking about an additional $60,000 that the IRS is looking at and say, oh, your client has this available to pay us, right? So this is an amateur mistake and a beginner's mistake, right? If you don't know, you just don't know. That we have to make sure that we're aware of is that the IRS has certain standards for allowable expenses, and you have to use that and be mindful of that. So this is the fix. Always check what the IRS's standards are. And even though a lot of us use software, right, to calculate this, I always double check. Okay, because I want to always double check and make sure. So this is the fix for this particular mistake. Okay, so let's move on to mistake number 2. Yes, miscalculating asset equity, right? Because it says on the form fair market value. So a lot of attorneys, CPAs, and EAs, they like, oh, okay, so let's use fair market value in our calculation to calculate equity. So for example, let's say you got a car. Your client has a car. The car has a fair market value of $10,000. Your client owes $6,000. Well, what would normally happen is you say, oh, okay, you got $4,000 equity in that car, right? But the IRS uses what they call a quick sale calculation, okay? They take 80% of whatever the fair market value is. So even though you may have determined that your client's fair market value in that car is $10,000, the IRS is taking 80% of that, which is going to be what? $8,000. The IRS would say, oh, $8,000 minus the $6,000 that's owed, that only leaves you with $2,000 of equity in that car. Versus, what did the attorney calculate? $4,000. So the attorney has basically overstated the client's equity. And if you consider that the attorney is going to make this mistake across all the assets that the client has, this can add up to thousands and thousands and thousands of dollars that you have overstated your client's equity. And guess what? The IRS is not going to fix it for you, right? Because to fix it would not be in their favor. So whatever you put on that form as your client's equity and you calculated it, right, and you overstated it, the IRS will say, hey, that's what you put on the form. That's what you calculated. That's what you submitted to us. And you know they're not going to take that if it's on the downside, right? But on the upside, that's what it's going to be, right? So we need to make sure that we're mindful of this. And the way that we fix this is always calculate the equity using the quick sale value, which is 80% of whatever you determine the fair market value is. And make sure too that you got several different sources for that fair market value that you are initially starting with. Because I've had many cases where I've had to go back and forth with the IRS on that fair market value, the original starting value, before we even took the 80%. Okay, so make sure you have sufficient documentation for that. So that's how you fix that mistake. The third mistake is missing dissipated assets. This is the one that blindsides a lot of people. And how do I know? Because I got blindsided by it, right? So let's dig into dissipated assets. Now, I'm going to read to you what it says. A dissipated asset is any asset that your client sold, transferred, or withdrew in the past few years that's no longer available. This is called a dissipated asset. So that 401k that your client cashed out a couple years ago, dissipated asset. That car that your client sold, right, and went out and spent the money, that's a dissipated asset. You know, that property, that rental property that you were renting out on Airbnb that you decided to sell to your cousin and pocket the proceeds? Yeah, that's a dissipated asset, right? So these dissipated assets, the IRS is going to treat them as, oh, you sold them, you cashed them out, you should have used that money to pay us. So they're going to add that back in to your client's bucket of equity. They're going to add that back in. So we have to make sure that we understand and ask the right questions. And keep in mind, you have to kind of dig for this information with your client, because I had this question on my questionnaire that I have for the client, right? But I didn't fully understand this whole dissipated assets, right? I didn't really fully understand that. So that's why I'm trying to make sure that you understand it and how it works. So you have to make sure you really ask the question, because you're trying to get to this whole dissipated asset situation. And in a particular situation that was my mistake, the IRS came back and said, oh, well, what happened to that $410,000 that he cashed out his IRA? I said, I'm gonna have to get back with you on that. I need to consult with my client. it. Like, and the client actually, at least the way they presented to me, is that they had forgotten about it because it was a few years back. They had kind of forgotten about it. They didn't think it was relevant, right? So that was a big mess that we had to sort out. But I don't want you to make the same mistake I did. I want you to learn from my mistakes. So make sure you ask your clients the questions up front, and you dig a little deeper so that you uncover those dissipated assets if there are any, and then you're able to deal with them up front when you submit your initial application for your client to resolve that debt, right? So that's the big fixer there. So here's the bottom line. The Form 433A, it's not just paperwork. It's the battlefield. It's where you really got to know what it is that you're doing. Every number matters. Every calculation, it matters. It matters that you understand the flow of things and you're not just putting in numbers into the software and have it spit you out somewhere. You got to understand what's really going on and what's really happening, right? So I want to thank you for joining me today. In tomorrow's episode, which is our last episode in this mini series, which will be the final episode, right? You'll have to join us because just because you master the statute, just because you master the numbers and you understand how they work on the 433B, now it's time for you to close the deal. So episode 3 drops tomorrow. Make sure you join us where we're going to talk about the strategies to use when dealing with revenue officers so you can get them what they want, so you can get what you want for your client. Thanks again for joining us, and we'll see you next time. Bye.